perspectives for regulating investments. And of course, I won't discuss with you again the Dubai ports, what's called the Dubai ports debacle, in at least one research piece about sort of the issues around Dubai ports and the regulation of that investment. But suffice it to say, there's a lot of interest around how to regulate investments that are made by Gulf-based institutions, particularly those with links to governments. And those are very fair concerns, and I talk about those in the book. And the last chapter is around Islamic finance as a capability, which is very important for any global financial institution. So today, HSBC, which is where I used to work, has a very strong Islamic finance business. Citigroup has an Islamic finance business. Standard Chartered does. Deutsche Bank. So any sort of serious global financial institution will have increasingly an Islamic finance business, but they don't all necessarily develop capabilities in it the right way. And doing so can make the difference between success and failure. So this is just to whet your appetite around these the logos that you see in front of you. I'm sure are very familiar, and these are some of the assets that are owned by Gulf investors, either partially or fully, or controlled by Gulf investors. So you see some financial services institutions. Barclays is there, of course. The largest single individual shareholder in Citigroup is Prince Al-Walid bin Talal, who's a Saudi investor. Deutsche Bank, again, major investments from the Gulf. If you look at the News Corporation, which you might be surprised to know that there's a significant Gulf stake in that entity, about 5% with Al-Walid, and others have their shares. Ferrari is 5% owned by Abu Dhabi, as is Aston Martin, which must be very fun investments to own. But also there's a strategy behind that. Apple, significant Gulf capital. And then some of the luxury brands, and there's one particular Gulf investor, a private equity firm called Investcorp, which has been very successful in buying luxury brands and improving them since the 1980s. So Tiffany's, Gucci's, Saks, and others. And so, you may not have realized it, but if you shop at Tiffany's, or if you shopped at Tiffany's in the 80s, you were shopping at a store that was owned by a GCC entity. Oh, and then, of course, you can't forget the Chrysler building down there, which is now owned by the Abu Dhabi Investment Council. So in terms of Gulf foreign assets, you heard the figure cited before about trillion, 1.6 trillion or so was the estimate in 2006. Obviously, markets have fluctuated since then. But a key thing to remember about Gulf investors, so if you read about institutional investors and endowments and trusts and the like, you'll see, of course, a lot of volatility based on the market. And that's the case. Now, with the Gulf, what's important to realize is that, number one, there's a very strongly conservative investment mindset. So a bulk of assets is held in either treasury bills or very conservative debt instruments, which are not as volatile. But more important than that, or perhaps more interesting than that, is the fact that Gulf investment institutions tend to get fresh capital injected into them as Gulf governments and economies generate surpluses. So that's a very big difference. So if you read about the Yale endowment or the Harvard endowment, and you say, well, look, they've lost billions of dollars in the last year in terms of value, that's true. And also what makes it more challenging is that people are not donating or adding to the endowment because the economy is tough, and that's not how the business model works. In the GCC, especially with the more heavy surplus states, there's even when markets go down, fresh capital comes in, and that's a very important distinction. If you look at some projections around how Gulf capital will grow through 2020, if there are no new investments, so let's imagine there's no single surplus between now and then, and all the Gulf investors do is keep their money invested and allow it to grow with a fairly conservative return rate. You see it's about 84% growth. That's just the power of compounding interest, if you will. That's a significant growth, though, when you're talking about a base of $1.5 trillion. Now, at a $70 oil price, that growth is much more significant. So it's about 3.5 times growth from what it is today. And if oil is at $100, which obviously it was for some time, and there are different projections as to where oil is going, but at a $100 price, you're looking at about 4.5 times growth in the invested wealth of GCC institutions. So it's a significantly growing phenomenon. Now, this is one of the most important things to remember about Gulf investment and Gulf economics more broadly, is that in the GCC, the oil and gas revenue that comes in from the governments is owned, or from the natural resources, is owned entirely by the governments. So the governments own these assets, and the national oil companies, which are again owned by the governments, they're the operating entities through which the work is done, but the dividends and the profits from that can flow back to the government. Now, each state in the Gulf has a different break-even point. And break-even point means that what's the price of oil that they require in order to balance their budget. That's the question we're answering here. And so the numbers, the analysis that we see is pretty striking. So if you look at Qatar, which, as some of you I'm sure know, it projected to have the highest GDP per capita in the world by 2011, if not sooner. So that's a pretty remarkable situation with Qatar. They only need about $20, a little bit more than $20 to break even on their budget. The UAE a little bit more, but still, comfortably in the 20s. Kuwait is higher, but that's because Kuwait's budget has been increasing for more investment. But in terms of their actual needs, they're fairly modest. Then you start getting to Saudi Arabia, and this is where things get interesting. In the sense that, Saudi Arabia is, of course, the largest economy in the GCC. It's about half the economy in GDP terms, and by population terms, it's 2/3. So it's clearly the single most sizable and important economy. But also what's important about Saudi Arabia is roughly, their oil price is sort of in the zone where oil has been trading over the last year or so. So depending on the day, either Saudi Arabia is making money or losing money, if you will. So either they're building a surplus or they're dipping into their reserves. And that, there's a big difference between those two situations. So Saudi Arabia is, very sensitive to the relatively small fluctuations in oil price because it's so close to its break-even point. If you look at Oman and Bahrain, these are two countries that require fairly high oil prices to break even on their oil revenue. When we looked at the world in sort of 2007, early 2008, you had very, very high oil prices. Everybody was, if you will, in the money with the oil price at 100, 120, 130. So therefore, these distinctions perhaps were less material. But as you get to a kind of lower, more modest oil price, these distinctions become very fundamental. So some of the oil producers have large surpluses at market rates today, and others have either modest surpluses or even deficits. Now, I don't want to go through this in detail, but the oil price, predicting the oil price is not something that I would dare to do. Except to note that it's hard to say where the oil price will go. There are certain fundamental drivers that are pointing towards a higher oil price, which is that sort of emerging market demand for petroleum is growing very rapidly, so there are more consumers of oil and oil products. So that's a fundamental driver. And then also, of course, with an increase in economic activity, it's not just consumers, but it's factories and manufacturers who use these products. So that would be an upward pressure. But clearly on the downward side, which is what we've been seeing, there's the recession that we've been through or going through right now is having a big effect on the oil price. And in fact, when people talk about how this global recession is affecting the Gulf, the key mechanism by which the Gulf is affected is the oil price. So that's really more than the credit crunch or exposure to toxic paper and the like. It's really the oil price is the fundamental issue. And of course, the rise of substitutes and for fossil fuels is a serious has serious impact on the oil price. So we've always had this pattern in the U.S. around when oil prices get high, there's a lot of interest in alternative energy, and then when the prices come down again, there's less interest in developing the alternative energy. What we're seeing now in the Obama administration is a sustained interest in this. So you didn't see a sort of tapering off when the oil price went down, which I think means that the spread of viable substitutes is taking